everyone, and welcome to BNSN on campus. Today, we're taking the lessons of the stock market to the SP Jain School of Global Management. Right behind me are the enthusiastic students who will be participating in an interactive session. So let's get straight to it and introduce our experts who will be guiding us over the next 30 minutes. Joining in on the show today, I have with us Nitasha Shankar. She is the head of research at Yes Securities, and also Kamlesh, CEO, Kotak Securities. Great to have you both with us. And Kamlesh, we were chatting a short while ago. You said you're a self-confessed backbencher, but one of the advice and tips that you had is that you should start to invest early into your career and early as a student. So what would be the keys to investing first up, according to you?
I think it's very important to start early because timing the market is never possible. We've tried it for the last 20 years, and I can tell you for sure, don't try and do timing of the market. Starting early, you are at different stages of your life at different points in time, so your risk profile changes over periods of time. So you're able to catch it a little younger, your risk appetite is slightly higher. As you progress, the risk appetite actually comes down a little bit. So I think one of the key things is ensure start young, start systematically, and always ensure some part of the earnings that you have, whichever way it is, actually goes into investing. That's important.
Nitasha, what's also important, and a lot of experts discuss it, is that it's so easy to look at the markets from a short-term perspective, but the whole idea of investing is that it's a long-term process. If you could just elaborate on that point.
So, if you're looking at investing, it's just like buying a house, and just when you go ahead and you buy a house, you don't really go and check the price on a daily basis. You certainly don't think that if I were to sell my house today, would I be in a loss or would I be in a profit? And it's very similar when it comes to investing in stock markets or even the other asset classes, that it is usually for the long term. And over the long term, you'll find that all your volatility and your variations and all of those jargons, they just smoothen out, and it helps to ensure best returns.
Okay, so view investing in the stock markets like you're buying a house. Now, we've got some questions as well from our bright students, so I'd like to start off with you.
Hello, hi, I'm Aniket Baradia. I'm a MBA student from SP Jains, and my question is very simple. As per the global risk reports of 2016, we've been seeing, they have highlighted a couple of risks, like they have highlighted a lot of involuntary migration which has happened, or the government and businesses failing to adapt to the climate changes, or we have even seen financial crisis and over-debt burdens by a lot of countries. And these changes, many of such risks are not only materializing but also are settling their roots around the world. So my question is very simple to you all: that how do you factor such risk and impacts of their timings in your investment philosophies, and do you predict any such risk coming in the near future?
I don't know how simple that question was, but if you have an answer.
Yeah, actually, if you look at the markets the way they are positioned today, volatility is a good word that is used. You know, it's like what we call ambiguity. Yeah, you can't eradicate ambiguity. I think in the world of investing, you need to make sure you are able to manage ambiguity. What's happening in the world is really, really diverse. Okay, so you have crude oil prices falling on one side. You could have a great benefit for India. You start worrying about what will happen to GCC. You have issues of consumption in India, but when you look at China, you're really worried because that's one country that consumes 30% of the iron ore across the entire world. So you stay in a very, very decoupled world at this point in time. My sense of advice in India, when you are in the place in the country, is to stay with the fundamentals. Yeah? There could be impacts around the globe, and it's not possible not to be interlinked, but I am saying crude prices for us is good. We keep worrying about currency depreciation, but in a country which has inflation of 4 to 5%, don't get too bothered if the rupee depreciates by that amount. You look at sectors within the country, and if you see the fundamentals of this place called India at this point in time, a lot is in favor. Yeah? Inflation, interest rates coming down, crude prices coming down. The important issue is how does it get utilized? So if crude has come down by so much extent, it has a great impact on our deficits. But if it is used prudently, it can get spent in areas of infrastructure. Spending on areas of infrastructure can make sure the entire consumption demand can go up. And for us as a country, we can depend on ourselves far more than depending on the outside world. So for me, keep an eye of what's happening around the world, but don't worry about that, because what happens there, you can't control either ways. But what's happening of that in India is what you should actually worry about when investing in India.
I think it's so hard not to worry right now, Kamlesh, with what's going on in the markets.
Do you see any resemblance of the present scenario to the 2008 after the Lehman Brothers? Do you see any resemblance in the present scenario to the old times?
That's an interesting question. We keep discussing internally for sure. I don't know whether we have an answer. I don't think there's a resemblance. The level of impact across the world could be more or less similar. The big issue is 2008 was all about leverage. Yeah? 2016 is not about leverage. So that's the one big, large difference. And therefore, to see that it could have a catastrophic effect across the entire world, I don't think that's really true. But volatility is here to stay. We still feel that there is still the worst in the market may still be there to some extent. So not as bad as 2008, but not as hunky-dory as we thought in 2015 for sure.
I have a simple question, I promise. Nitasha, take us through, some specific do's and don'ts for first-time investors.
So it's very important not to get carried away by news channels and the news media, because what happens is that they like to, it's their job to report every single thing, and it's very easy to get lost in all of it and probably overplay every factor. So that's point one. Very important. Point two is that you always go back to the fundamentals and do your own homework, because after all, it's your money that you're looking at. You're not really looking at investing someone else's money. It's easier with taking risks with someone else's money relatively to some extent, but it's wrong. It's morally and ethically wrong. So it's essential to do your own homework. Keep your eyes and ears open. Keep your eyes and ears open as to what's happening around you. But if your fundamentals are looking good and you're very convinced about your idea and you have a lot of conviction towards it, then go ahead and invest, and keep on investing a little bit every month or every quarter as whatever you're comfortable with, and keep on doing that. You will eventually accumulate wealth over the long term. And just, when you see all these kind of panic talks coming in, probably just shut down all the news channels and go back to your basics. If something has changed there, then go ahead and sell. Otherwise, just use that as a time to get things on a discount.
And tune in to the news channels when you're giving all of this advice. But we have a question from the young lady in the front.
Okay, hi, my name is Ritika Karwat. I'm doing the Global Family Managed Business Program at SP Jain. And I want to get back to the question regarding crude oil, because that's one of the most current topics at the moment. So, it's been extremely stable for a very long time. And it's now experiencing a bear market. With the unlifting of the trade barriers in Iran, it's further decreasing. So, with your experience, would you advise a particular sector or companies, like we know that Asian Paints is doing really well because of the current situation, raw material price dropping drastically for them. But which sectors do you think will grow in their margin expansion? And as an investor, which sector do you recommend that we should invest in at this moment?
And ET now anchor in the being. Question, your answer, Nitasha?
So, see, if you're going back to the crude prices when it was just a little over $100 a barrel, at that time everybody thought it's going to just head upwards. And when it came down to about $50 a barrel, everybody thought it's going to remain there. And now everybody thinks it's going to sink further. So yes, there are a lot of factors which go into predicting the crude oil prices, and it is difficult, not impossible, but it is difficult to predict that. Having said that, if you're coming into the domestic sectors, there are a lot of sectors which would benefit from the falling crude oil prices. As you rightly said, Asian Paints is one of them. So anywhere where crude is a raw material, and when it comes into the expense side, so there is a direct benefit that comes into that company because they're able to do that. But if you have to pass on the benefit, then you would not really enjoy it to that extent. So that is something that you really need to look into. Airlines is a sector which is a consumer of crude, and things have been quite bad with them for a while now because of competition, and most of their costs are essentially structurally fixed in nature, but that's a sector which would certainly benefit from the following crude oil prices. Having said that, they also tend to not enjoy they tend to enjoy operational leverage. So whenever unless and until there is a growth on their top line, you're not going to see the margin expansion coming in, but they certainly benefit from it. And other sectors like paints and varnishes, that's another area that benefits.
Okay, crude's been a big headline. We've been talking recently as well as to how the prices are lower now than a bottle of water as well. But let's get in the next question going.
Hi, my name is Devanshu Gaur and I'm doing global business management from SP Jain. Whenever I talk to my parents about stock market, they often refer it as a gamble. And it's very disappointing for me being a BBA student to suppress my enthusiasm like that. So why do they refer stock market as a gamble?
So glad he's asked that question because, I mean, a lot of people never acknowledge when they lose money. They're only telling you when they win, but there is that dark side to the markets. Any advice that you may have?
Actually, the sad part about the Indian market, if you look at it and split it, is say the volumes in the Indian market, which is say roughly about 2 lakh crores on a daily basis, actually comes only out of cash market at 20,000 and FNO at about 1,80,000. If you break up the 1,80,000 of the FNO market, it's about 1,50,000 on options, which is the Nifty, and 30,000 is on FNO. So the real thing that you buy on which there is underlying in cash is actually only about 10% of the entire market. The worry in the market, like somebody asked, what's the method of investing? I think very important that a lot of people don't buy a wrong product. Actually, there is a huge mismatch between their risk profile and the product that you are buying. So people often worry about a wrong product bought. There's nothing called a wrong product, okay? Options have their own fundamentals, but only if you understand. I mean, at 1,50,000 crore volume every day on the options market, I can tell you for sure that 70% of the guys who come in don't understand that market at all. And they lose money. And when you lose money, it always sounds like a gamble. Okay? So if you are in the right place, if you invest in what you understand, and consumers, I often tell them as part of their allocation, that if you invest in something that you understand, it'll always be not a gamble. But if you want to invest in something which sounds exotic, sounds very good, sounds about making money quick and fast, and then you lose, it always sounds like a gamble.
Yep, so bottom line is to do your homework as well before you invest in the stock markets. We've got lots of questions coming up from the young students at SP Jain, so stay with us. We're taking a quick break and we'll be right back. Welcome back. Still tuned in to BNSN on campus. We're at the SP Jain School of Global Management in conversation with Nitasha, Shankar, as well as Kamlesh Rao. And I'd like to ask you both, because you've been veterans in the stock market so far, there's been so much advice, so many gurus to look up to. Any memorable quotes, anything that you would like to outline for our students here?
I don't know about people, but I think there are thoughts which are very, very strong. So we constantly run the organization based on this fundamental thought that when things look very good, they may not be as good as they look. And when things actually look very bad, they may not be as bad as they seem. If you catch both ends, you catch the upside reasonably well and you manage the downside reasonably well. So I think that's one of the firm thinking processes by which we run businesses and advise to our customers.
Nitasha, any memorable quotes or?
I think the bottom line in everything that we're doing at our organization is that price is what you pay and value is what you get. Because unless and until the value justifies the price that you're paying for any asset class, it could be equities, it could be debt, it could be mutual funds, it could be anything. As long as the price, if the value does not justify it, we just don't go ahead and recommend it. And we believe that that is the mantra for long-term returns.
Okay, let's go to some of the future Kamlesh Raos who are sitting right at the back and go ahead with your question.
Yeah, this is Chirag from the Big Data program. So I've been kind of told that the strategy for picking stocks, if you do it purely on the company's financials, your return would be considered even lesser than a bank's interest rates. So what are your views about this? Do you agree with this or don't? So what are your views?
Actually, at this point of the market, if you, it's not about looking at just the fundamentals. I think it's also looking at beyond the fundamentals. Your comparison is right because for the last 1 year actually bank deposits have, as an asset class have given the best rate. So I don't want to get into that comparison, but I don't think there is any substitute than looking at the company's fundamentals. Today what companies are doing well are the ones who have not very large leveraged balance sheets. Debt is a large problem. Imagine somebody sitting on cash at this point of time. I mean, every stock looks like from its highs is about 30% to 40% off. So cash is king, and that essentially comes out of companies which manage their fundamentals very well. I don't think there's any substitute to fundamentals of companies, and that's the way it should be in investing.
Just wanted to get in a quick perspective as to what exactly the understanding right now is, Nitasha. Everything is gloom and doom wherever you turn, but some experts, allude to the fact that at least India is standing out among some of the other emerging markets in light of our growth. Is it a good time to invest right now? What's the outlook for 2016?
So this is a perfect time to invest because as I said earlier, fundamentally we are in a good position. India is better off as compared to the other emerging markets and the other global markets as such. So you have inflation that's coming down, you have interest rates that are coming down, you have a government who is spending towards infrastructure, who is spending towards ports, railways, everything that is literally forms the backbone of the economy. So the chances of economic growth coming back, or rather the probability, is very high, and the probability to increasingly improve the growth is also very high. As compared to the rest of the world where commodity prices being low, they do not have that kind of export kind of growth coming in, the domestic consumption story is bad. So on and so forth, they all have their individual problems, and that's going to continue for a while. So fundamentally, India is in a very good position. It's just a matter of time as to when investments would come back and when the cycle is going to turn for the positive, even for the corporate earnings. So this is the time to buy. Yes, it takes a little time for things to happen. They don't happen overnight. Steps are being taken, measures are being taken in order to boost that growth. It doesn't really happen overnight. So you have to wait and watch as to when that happens, but this is the time to buy.
And patience is a virtue, but I think you should note down that point that this is a time to buy. And let's get our next question going then.
Hi, Kamlesh and Nitasha. It's great having you on the campus. My name is Tathagat Das Sharma, and I'm from the Executive MBA batch. So let me tell you two scenarios, two customers, who are always there on the market. One is an IT sector. Being from the IT sector, I know half of the times guys are not coding, they are on the stock market channel. And the second is, of course, someone who is retiring. My aunt who is retiring from her work and she wants to get into the stock market. So the question to both of you is, are we doing enough as an industry to generate that awareness or that education to get these guys on board and do good investment?
We do that every day of our lives.
Yeah, so are we doing that? It's a conscious question. With all the wolves on the street, are we doing enough as an industry to generate that awareness? And would you like to have more of us investing in the market, or would you just bank on someone like a big investor investing in security firms?
So we constantly have this worry that finally for a market that you want to grow, if it has only 2 crore demat accounts, but fundamentally for being in the direct equity market you need to have a demat account. That number is just about 2 crores. 52% of them are active, 48% are inactive, so that brings it down to just about 1 crore. We've been pushing Jan Dhan Yojana, saying if it happened to the world of banking accounts, something similar should happen to the world of demat accounts. Coming back to your question, I think the whole world of SIP, which is systematic investment plans that you have, and for your aunt, and that's the best way to enter the market. I don't know whether it is direct, but through the equity mutual funds. Though I constantly worry whether as you grow in age, your risk profile should start becoming more aggressive, because all your responsibilities are over and so on and so forth. So we see a lot of people at the higher age bracket want to go back to fixed deposits and mutual funds, whereas our belief is that's the point that you should start getting more allocation towards equity. But on the IT side, when you are younger, like I said, you have risk appetite, and therefore it always makes sense to get into the market. And today everything that you want to do, whether it's information, and I don't say electronic media, whatever you want is available on the net. I mean, and you don't even need to have a laptop for that these days, because everything is available on mobile. That's the destination device everything is moving to. For example, at our place we don't even think about whether should I go to tier 4 cities or tier 5 cities, because I think the mobile will take me to the tier 4 and tier 5 cities either ways. E-com is booming in that area. So everything is available. I think you got to use information well. Don't worry about personalized information. Research is available today in multilingual languages, available on the mobile, and therefore make the best use of it.
What about you?
Hi, I'm Manar Dhruva, and I'm doing my BBA course over here as well. So you mentioned that today's environment is very volatile and ambiguous. So one question that all of us would like to know is, would like to get answered is, how do you measure the systematic risk before investing into a stock?
Yeah, like I said, fundamental evaluation is always very important. And once you look at the fundamental of a firm, it's far easier then to look at the category it belongs to. So if you're looking at one particular firm, then it becomes easier to compare peers. Once you compare the peers, you're able to find the better guys in that sector and in that market. But if you're getting into specific sectors, then it's important to have an evaluation. For example, if you're looking at IT today, then we would have a positive bias on IT because a lot of the IT consumption happens overseas. That's a large part of a market. If US and UK are doing well, so you start with the overall global scenario for the industry in particular, get down to the companies that you want to look for, look at the peer group, and that is where you try and pick up the better guys from the block.
Okay, we're winding it down, so let's get in our last question of this session.
I'm Aditya Sood, and I'm doing BBA in SP Jain. I'm a young investor and really enthusiastic about it to start investing in this market. I've heard people invest in fallen stocks, and I was very curious to know, is it really wise to invest in fallen stocks? And how do you really come to know, how do you judge that, okay, this stock is fallen, but it will rise in the future?
Oh, if we could only answer that question, we wouldn't be here today. But I think I'd like to add to his question is that a lot of people are saying now some of those blue chip stocks that are at very juicy levels. What's the view when it comes to that?
I don't think there's anything called falling stocks. Okay, so you start at a particular point of time. First, you want to buy a stock. And when you're sure about that stock and you're sure about the fundamentals of that stock and the sector it belongs to, then don't bother if it falls. If it falls, then there's an opportunity to keep buying. Yeah? Your starting process can't be based on falling stocks. Your starting process has to be based on the stock that you buy. And if you are sure that's the right stock to buy, please keep buying it when it keeps falling.
Nitasha, would you like to add to that?
Yeah, just to add on to that, of course, it's very important to keep your fundamentals in mind. And again, when a stock is falling or the stock price is falling, it's always good to revisit your fundamentals. And if nothing has changed, then don't worry about it. But if things are changing, just don't try to keep on averaging downwards because you may just be trying to catch a falling knife and that could hurt you eventually. So it's very important to keep in mind the fundamental basics as to why you invested in that stock and whether that still remains or not. So blue chip, small cap, mid cap, it's just the same thing all across.
Okay, and before we let you two go, let's just have you run us through your top sectoral bets. Nitasha.
So our top sectoral bets right now, of course, is infrastructure with the way there's a lot of investment being done and most of the companies are well poised to capitalize on that growth. So that's a sector we are very positive on. Again, riding on the way the economy is expected to turn around and with the improving consumer sentiment, we are also very bullish on the auto and auto ancillary stocks because that's the first one to start riding out whenever the economic cycle turns around. And always prudent to have IT stocks in your portfolio. That's another area which we are quite bullish on in addition to the other two.
Kamlesh, what's on the list?
She stole my answer.
So all of the same sectors?
Yeah, infra, auto, the only thing would be financial services because that's the other area that will get impacted by drop in the interest rates and that's how things are going to be. I think last on the block would be the consumption story. So the FMCG guys will follow a little later, but I think the frontline ones is what we spoke.
Great minds think alike. That's definitely the call today from our experts. We wrap it up on this edition of BNSN on Campus. Hope you enjoyed watching.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.